Good afternoon, everyone. This is Martha Campbell here at RMI. Thank you for joining us for today's webinar. We will be talking about our Finance the Future initiative, and we have two great guest speakers with us here today. Bob Sahidi from the Institute for Market Transformation, and Phil Henderson from the National Natural Resource Defense Council. So I'm going to go ahead and dive straight in. Just a couple of logistical items. If you have questions during the presentation, we encourage you to chat those in, and we will keep tabs of those during our question and answer session. And if for some reason there are any sort of audio issues, please feel free to chat those in as well, and we'll try to address that. I'll also remind our speakers to please stay on mute until they're presenting, just so that we don't have any feedback issues. So just to quickly kind of go over what we'll be discussing today, we'll first introduce you to RMI and the Residential Energy Plus program here that this initiative falls under, just in case you're not familiar with either of those two things. Then we'll discuss what the initiative is focused on and hopes to achieve, and then we'll hand it over to our guest speakers after some introductions, and they will talk about a specific opportunity we are pursuing called the Duty to Serve rule that the Federal Housing Finance Agency has opened up for public comment. And then lastly, we'll open it up for your questions and answers. We hope to have the first part of the presentation last about 30 minutes to give you ample time to have your questions answered. So for those of you that are not familiar with the Rocky Mountain Institute, we are an energy think and do tank, as we call ourselves, focused on transitioning our economy off fossil fuels to create a clean, prosperous, and secure future. And we focus predominantly on market-based solutions to that transition. We have several attributes that we like to think we incorporate into our work more so than other organizations. And one of those is a whole systems approach to problem solving. And we really try to stay nonpartisan and independent in how we think through problems. We've existed for over 30 years. We were co-founded by our chief scientist, Amory Lovins, a little bit of an eco-celebrity if you've heard of him, and were originally founded in the Roaring Fork Valley in Colorado. We have offices now in Boulder, Basalt, Washington, D.C., New York, and Beijing. And just recently we merged with Richard Branson's Carbon War Room, who also has a similar ethos of focus on market-based solutions. So a little bit about Residential Energy Plus. This was a program that was created at RMI over the past year, very specifically focusing on the residential sector in the built environment. It lives in our buildings practice at RMI, and we are specifically trying to help unlock the market to capture roughly $150 billion market in the single family home energy efficiency and distributed energy resource market. We have three main pillars to our strategy. The first one being focusing on really increasing consumer demand for home energy upgrades, and we're calling this new normal. The second category is around making the value that home energy upgrades create in the home more transparent through the valuation of homes, as well as making it clear to homeowners what the cash flow implications are of having energy efficient homes. And then lastly, just a reinforcing strategy to the other two is ensuring that the bandwidth and the service providers and the financing are available to meet this uptick in consumer demand that we hope to stimulate through this initiative. So the Finance the Future initiative kind of resides a little bit in the ready resources category and the visible value category. And what this initiative is specifically focused on doing is leveraging a public comment period opportunity that we became aware of. The Federal Housing Finance Authority has a rule called the Duty to Serve Rule. And its purpose is to inform financial markets on the underwriting practices for low and moderate income households in specific housing markets in the mortgage industry. And we'll talk a little bit more about that here soon. But that's what this initiative is specifically focused on. And in doing so, what we're doing is hoping to address some of these market failures that we're seeing in the real estate and financial services industry, where these multiple values that home energy improvements provide are not being recognized and valued in those markets. And this initiative was specifically hatched out of a workshop that we recently had in Washington, D.C. We had over 50 industry participants attend, and they identified this as a very high opportunity or large opportunity for influencing the mortgage industry and the real estate industry. So I just want to quickly introduce you all to our speakers today. Bob, who will be joining us in the latter half of the presentation, is joining us from the Institute for Market Transformation, and he leads their work on expanding energy efficiency financing solutions for homes and commercial buildings. One of the primary projects that IMT has been focusing on recently has been the SAVE Act, which is a proposal submitted to Congress and now sitting in committee in Congress to incorporate underwriting standards into the mortgage underwriting industry and appraisal industry. Bob has an extensive amount of experience in the financial sector. He's worked at Green Space Investment, where he was a managing principal. He was also a senior staff member at Fannie Mae, and was vice president of product development and mortgage-backed securities. While there, he was involved in some of the innovations at Fannie Mae that included energy-efficient mortgages, as well as smart commute for location efficiency, homestyle for renovation lending, and also the Home Counselor online business platform. Bob has held several positions in the federal government, including at the U.S. Department of Housing and Urban Development and the Executive Office of the President. We are very excited to have Bob joining us today. And then who I'll be handing it off to next is Phil Henderson from the Natural Resource Defense Council. Phil also has had an interesting background in the financial services industry. He's worked on Capitol Hill. He's worked at several law firms, but he was also legal counsel and on the business strategy team at LendingTree, and also worked as general counsel for Overture Technologies, which is a firm that creates underwriting systems to enable greater rigor and transparency in loan underwriting and due diligence. So he brings that insight to his work as well. So I'm going to go ahead and hand it off to Phil, and we'll talk about the duty to serve rule.
Okay, thank you, Martha. Hello, everybody. I hope you can hear me clearly. Let me start with just a comment or two of background that I think will help shape up why this webinar I think is of interest to a lot of folks who work in the energy efficiency kind of sector, and to give some clarity to the opportunity at hand. So FHFA is an independent federal agency that is the conservator of Fannie Mae and Freddie Mac. Fannie Mae and Freddie Mac are, as I think everybody probably knows, institutions that have been around for a long time that provide liquidity to the mortgage market. They basically purchase or securitize loans made by lenders. And FHFA's role is really quite unusual. It's an outgrowth of the kind of unusual nature of these institutions that were chartered by the government but were shareholder owned, and maybe still are. It's not exactly clear how that plays out. But FHFA is we can think of them as a regulator here. And Fannie Mae and Freddie Mac, in recognition of their very unique position as being created by, chartered by, and connected to the government, have an obligation that is shorthand duty to serve, but the underlying obligation is to make sure that their products and services and functions serve the entire mortgage market. At a certain time, these concepts were kind of called housing goals. Duty to serve is, I think, shorthand for the attempt to give a lot more clarity and precision to what that means for these institutions. So with that in mind, FHFA has issued a proposed rule. It's published in the Federal Register. It's being issued pursuant to conventional administrative proceedings related to rulemaking, which basically means they publish the rule, they take comment on it from interested parties, consider those comments, and will then, one expects, publish a final rule, or could potentially publish another proposed rule incorporating comments and then again putting it out for further comment. So that's where we are. They've issued a proposed rule, and we're going to talk about what it is. And the idea is that people who have expertise on the subject matter can offer comments to FHFA for them to consider in making the rule better, to work better in the market. And there's an element of it that relates to energy efficiency improvements to homes and buildings. And so that's the connection here, is that the folks in the industry who understand the various dimensions of how this works in the market, not only have the opportunity to help FHFA, but I think it's fair to say FHFA and folks in the mortgage industry actually need this input and would appreciate the expertise that you can bring to a lot of the subjects at hand. So with that as background, the three areas that have been identified as part of this duty to serve, it's specific markets. Number one is manufactured housing. You can understand how without a specific objective to serve this market, conventional mortgage financing might not reach it. And it's limited to manufactured houses that are titled as real, with the real property, so that they're subject to a mortgage. Number two is preserving affordable housing. And the idea, quite logical, is that by reducing utility expenses, you reduce the total cost of housing for the occupants, thereby making housing more affordable. And it can be applied, and is expressly applied in the proposed rule, to both single-family housing and multifamily housing. Both Fannie and Freddie make multifamily loans as well. So the question there is, how can Fannie and Freddie participate in the financing of efficiency in single-family and multifamily housing to make it more efficient, to therefore reduce the total cost of housing for the residents and owners. And then the third area is in rural markets. Now, in my expertise and experience, the areas that I am most likely to feel the kind of room to make comments on relate to number two, preserving affordable housing, and how can Fannie Mae and Freddie Mac help improve housing with financing, improve the efficiency of housing with financing. So on the screen here, on the webinar, I've listed 7 points, and just want to hit each one of them fairly quickly, that go to questions posed in the rule and what I expect to be areas where FHFA would appreciate and benefit from comments from folks in the industry with real experience on how this works. Number one is with regard to any financing of energy efficiency improvements to a home or for the purchase of a very efficient home, what is the role of estimating the savings that are expected for the homeowner or resident, and how should those savings factor into the underwriting or the property value elements of the loan? This is an important point for lending, obviously, and is an area where a number of folks have suggested to Fannie and Freddie previously that they should act on, considering savings as an element of the loan. Number two is, to the extent you do consider savings in the loan process, whether in the underwriting of income or on the property value, what's the role of estimating? How do we go about estimating those savings? Do you have audits? Do you use some other version of estimating? Perhaps there's a before and after Energy Star score or a HERS rating on a house, some ideas. Coming up with specific guidance on how to think about those estimates is an important question in the proposed rule. Quality control is quite important, and I think folks in the energy efficiency industry have been a little spoiled by the good quality control that exists among providers. But if you put yourself in the shoes of a regulator that typically deals with much more conventional home improvement loans, a lot of questions arise about how do we assure the work is of quality work? How do we assure that the homeowner doesn't have negligence claims against the provider if they're financing the improvements? I think there's some interesting opportunities for the lending institutions to learn from utilities and utility programs. So that's an important question. Fourth is, how do you go about implementing these concepts? Is it a new loan product, or is it applying flexibility with existing products? Fifth, the proposed rule separates questions relating to multifamily loan products and processes versus single family. So there's an opportunity to be quite specific in the guidance on all of these questions with regard to different property types. Sixth, the proposed rule expressly asks about water efficiency, a subject that I think we too frequently leave out of energy efficiency discussions. And I think there are fewer programs that use financing of improvements to accomplish water efficiency out there in the market to look to. But to the extent there's guidance, I think it's needed here. Seventh, the rule does not mention the possibility of solar power for homes as a way to accomplish lower resident expenses, but it's clearly an opportunity, and so some specific input there I think would be interesting. And let me wrap up by saying that the proposed rule is available. I believe the site is on an earlier page here, but you can certainly find it just by Googling FHFA and duty to serve proposed rule. It's worth reading. It's important to read it and to understand the questions posed before submitting comments. And I want to just end by saying, to those of you on the call with experience in the market, I think it's fair to say that all the stakeholders involved would appreciate input. And let me end there and thank everybody for attending.
Great, thank you, Phil. And now we'll pass it over to Bob.
Hi, everybody. I'm going to take probably a little more of a single-family approach and talk about some of the questions but then throw out some ideas that you might consider in terms of commenting on this proposed regulation. And I think the important thing, as Philip mentioned, is expertise, and I think that goes two ways. I mean, certainly to the extent you have technical expertise, they would certainly appreciate hearing that. But one thing you all do have is market expertise, and you know, this is a duty to serve, and they're more concerned about the impact on low and moderate income borrowers in those communities where they reside, as opposed to necessarily saving the world in terms of energy efficiency. So keep that perspective. So with that in mind, you know, let's talk about low and moderate income borrowers in your market. So they're asking what is the case for different loan products, different underwriting standards, innovative approaches to meeting this market. And so I think areas that, you know, you could be commenting on is that, yes, we see a high demand for these homes, but people aren't building them because possibly they can't get the financing value out of them. Remodeling market, you know, this is difficult to always, you know, people that have more money generally get it done, particularly low and moderate income people who most need to remodel their homes, particularly from an energy efficiency point of view, might be stymied. We live in a very high utility cost area, and so to the extent utility costs could be reduced, this is a big thing in terms of moderate income borrowers being able to sustain home ownership. You know, rental single family comes into this, and I know in a lot of communities across America, rental housing is becoming a bigger and bigger issue in the single family space because of foreclosures. A lot of companies have come in and bought these homes, or community groups have come in, and so to the extent you're dealing with some of those kinds of issues, which is like, wow, we're dealing with this older housing stock, it's coming on the market, you know, to the extent we could renovate these homes and put in energy efficiency, this might be really helpful to our market. So kind of the takeaway here is think about your market, think about what's happening to low and moderate income borrowers in your housing markets, and how this particular reg, the energy efficiency components, could help bring affordability. Next slide. Financing, obviously, this is, as Philip said, this is what these GSEs, agencies do, is they don't necessarily lend money themselves. They have a whole lender network of, you know, probably a couple thousand lenders across the country. And, but, you know, I think what's happened here is that very few, if any, have offered anything concerning energy efficiency, although there might have been some products on the books that no lenders that know anything about it. So, you know, commenting on the dearth of local lenders offering anything in terms of energy efficiency is, I think, an extremely good comment. Some lenders may balk and say, oh, yeah, well, I'd like to do this, but automated underwriting doesn't really allow me to do that. So if you've heard that one, sort of throw it back at them. You know, I think people think of new housing as being expensive housing as opposed to older housing, but there's a lot of new housing coming on the market, like energy efficient condos, which are considered single family houses, or more moderate income townhouses, which are being built more energy efficient, but a lot of those consumers might have difficulty you know, paying that extra couple of % more that those homes might cost. So if you have those kind of issues, you know, I think they'd like to hear about that. They talk about a product that they have where it's they will allow, you know, that the home has to be improved 15% to qualify for their particular products. I think that's something, I think as you start to throw thresholds out there, it becomes dangerous. I mean, somebody might be refinancing a home or buying a home, and all they really want to do is incorporate a new HVAC, which might give them 10 or 12%, but certainly it's something that's positive. Does this 15% create too high a threshold? Or some people conversely might say, well, geez, this should be a lot higher. So I think if you've got some experience, particularly those of you in the rating business that deal with this on a daily basis, I think you certainly have some comments here, and I would really focus in on that. Do the savings derived from the reduced consumption have to offset the upfront cost? You know, generally that's a good rule, but I think we need to think about what's really happening in this space, particularly in the home improvement space. What are the costs for improvements? Even if they, you know, I think the problem here is that, and I've seen this where people are buying an older home and maybe it has an operational furnace, but that furnace is going to go in a few years, and so maybe they're, you know, buying a new furnace, and maybe that's not necessarily going to pay for itself right away, but when you consider the cost that it might have if they waited 2 years and had to buy it on a credit card as opposed to buying it on a mortgage rate. So I think there's a lot here in terms of how things are financed. If you're dealing with consumers, what have been the issues that they've had? How do these questions they're asking meet the kind of issues that you've dealt with in terms of helping consumers get financing? Or conversely, they might not even be asking the right questions. I think that's also a possibility that, you know, here are the questions they should be asking, and here's what you think are the problems. So this is a chance to get really creative, particularly those of you that are in the remodeling business or in the new construction business, to you know, really give them a dose of what you've seen firsthand in your markets. Next slide. Underwriting, they've asked some questions like what's a reasonable time period for the reduced utility cost to offset the upfront cost of improvements. You know, those of you who are kind of in this sphere, I think, you know, generally the thought has been you know, the life of the equipment, which might be 10 years or what have you. But if you've got some other ideas, that would be great. Should energy efficient loans always be in a first lien position? And I think this comes back to what I mentioned on the financing, is that, you know, you might have consumers that have recently or refinanced a few years ago even, that have nice little 3.5% mortgages and don't really want to refinance. Should there be second mortgage products that could be used here? Stretch ratios. The stretch ratio is that, you know, in effect, borrowing a little more money, but then on the other hand, my costs are coming down. Can people get a bump or some kind of break on their debt-to-income ratio, which is a key underwriting ratio? Debt-to-income is like when you add up all your monthly payments, car loans and credit cards, as well as your mortgage, as that as a percentage of your income. And the rule of thumb is that should be, FHA says it should be 41% or less. Fannie Mae and Freddie Mac are usually in the high 30s. Maybe that should be 36 to 38. But you know, should there be something there that recognizes that? I think that's a key point. You know, they mentioned about the soundness of energy efficient loans, and they reference a study that we were involved in where these homes really did foreclose much less often, 32% less than other homes across the country. But is there things in your market which you're seeing, you know, in terms of less foreclosures, or maybe you're starting to see green premiums? There's been a few studies that have, like in certain parts of the country, one more recently in Washington, D.C., one last summer in New England. I think there's some coming out of the West Coast. If you've seen green premiums, you can say, hey, I'm seeing less foreclosures. I'm starting to see premiums. This is good business. So I think, you know, what can they do in terms of underwriting to make this more accommodating? So if you've got ideas along this line, and I think, you know, this is your chance to bring them forward. Next slide. and appraisals, which is of course a part of underwriting, they keep using as completed appraisals. And the problem with an as completed appraisal is that generally it means a market approach to appraisal, which I think it's a chicken and egg situation whereby you have 2,000 square foot homes in some subdivision where every home looks alike, and one home's energy efficient and one isn't, and the one sells, the non-energy efficient home sells for $200,000, and now you're putting in these energy efficient improvements into, a similar home. Is it going to appraise for $210,000 or the money that I put in? And if they don't recognize the energy efficient improvements, you're not going to get that value. And of course, the existing 1004 form really doesn't recognize much on energy efficiency. So I think one of the things that FHA did in the recent regulation, FHA being the Federal Housing Administration, which is of course part of HUD, is they authorized a modified income approach to value where the appraiser could use the net present value of the energy savings from the HERS report to really get a better approach to value. I think too is that as homes become more and more sophisticated, taking the car model, used to be cars, for those of you that are my age, cars used to be sold that, I had so much chrome, I had so much mahogany on my dashboard, and I had a 440-inch cubic inch engine, and that was the value of my car. And now, as we all know, we're looking at crash tests, residual values, maintenance, probably 20 different statistics or more on the performance of that car to determine value. I think housing will ultimately move that way, and I think, they have to be nudged to see that this is happening. One thing of interest is the appraisal organizations. The Appraisal Foundation, which is a congressionally chartered body, has just recently released their first exposure draft on valuing these homes. And they really look at them as high performance, trying to stay a little bit away from green, but that, here's two different pieces of real estate and one performs better than the other. Also, the Appraisal Institute, which is the trade association for the largest number of appraisers, has adopted a green addendum. So there's a lot of things happening in this appraisal space, and I think they have to get caught up here. So if you've got some experience in appraising or you've seen appraisals as an issue, feel free to comment here. Next slide. Data. I think data. And I think they're calling for some data here. And I think the questions here is, should the lender be required to verify before closing a loan that the projections and the proposed energy will likely reduce consumption? And then, what are the standards of determining that? And so those of you that have technical expertise in this area, you HERS raters and BPI guys, and this is a chance to show your stuff. And then, after all that happens, should the GSEs be required to verify after closing that the energy improvements actually reduce costs? So I think, what we're talking about is, they have to have information. So to be able to have the HERS rating from ResNet, these things are available in the registry now. That could go into the loan file. The Department of Energy has just come up with a home energy score. That rating could go into the file if that's what's used. There's green multiple listing data that's available. And then they have something, the GSEs, called the Uniform Appraisal Data Set, where they collect this information. I think they should be encouraged to collect this kind of information for every loan going forward, so they can start to, in effect, see that these loans that had more energy efficiency data, did they perform better than comparable homes that didn't? So I think, there's a lot of things here. There's a lot of other data that we might be missing here that you should feel free to comment on. Next slide. And then there's other issues, and this kind of falls under what investments and grants by GSEs are required to meet the needs of this underserved markets. And so, this is your idea, opportunity to be creative. One of the things is people I know have complained about the cost of a rating that might be $400 or $500 or more in some markets, to the extent that those could be brought into the closing cost, or there'd be some grant that would pay those for consumers. The GSEs have come up with something called loan level price adjustments, which is like talking about risk-based pricing. So if you have a higher loan to value ratio, you borrowed 95 cents on the dollar versus somebody who only borrowed 80 cents on the dollar, your risk is going to be higher. If your FICO score is lower, your risk is going to be higher, and you may be pay a premium. But we're trying to say here that these homes should be better on average, and so possibly they should get a lower interest rate. And actually, Fannie Mae is doing this on the multifamily front. I think we can all agree that there has been little activity in the markets coming from the GSEs. So more lender training, consumer information. There's a lot that can be done in this space, and to really let people know that these opportunities could be available, financing to do these things. And better marketing of programs, bringing in community resources. I think a lot of utilities have programs, and a lot of cities have programs, and but to the extent that you have this financing from the GSEs, a lot of that local program money could be used for training, marketing, technical assistance, counseling, and let these other people do the financing, because this is what they do to the tune of billions of dollars a day. And then also in terms of other issues, I think this is also your opportunity. If there's something that you think, and this is an issue I know that's near and dear to a lot of us, Philip included, is minimum property standards. Right now, the GSEs don't have minimum property standards, whereas the FHA, which I mentioned previously, does have minimal property standards requiring, I think it's IECC 2009, which is a code standard. And then to the extent you don't have minimum property standards, you might be seeing a lot of shoddy construction in your marketplace. So this could be another thing you could talk about. And certainly, this is very open-ended, so get creative. So that's kind of it for me, and I'd be happy to take questions at the appropriate time. But I think what I've tried to say here is that these agencies are looking for really market-based information, technical expertise, and so I would feel free to comment on any or all, and you don't have to comment across the board. If you've just got some, very small technical point, then comment on that. But I think if there's something in here that you feel strongly about, this is your opportunity. Okay, Martha.
Great. Thank you so much, Bob. That was very helpful. And I liked the level of detail that you got into with some of the recommendations people can make. I want to invite people to either raise their hand using the little hand icon on the webinar platform, or to chat in any questions that they have for Phil and Bob. So while we wait for those to start kind of rolling in, I have a few here that we've come up with for you all. The first one is for the folks on the phone. Do they need to respond to the very specific number in the set of questions that the FHFA has laid out, or is it appropriate for folks to make have a letter that's full of kind of these larger concepts and recommendations, but doesn't necessarily speak to a specific question number. What would you all recommend? And I'll just toss this over to Phil just for clarity.
Sure. Well, it's a good question. I actually intended to say something specifically about that, but I was watching the clock and tried to wrap up. Well, it's really a balance. I mean, I think on the one hand, FHFA has done a good job of identifying important questions and, knowing what it knows, has said, hey, these are the issues we think are important. So, tying a comment to one of their questions will help them to understand it. On the other hand, commenters are definitely not constrained to only comment on a specific question. So, for example, one of the things that I expect to offer in our comments is, the role of utility programs and tying potential financing products to existing utility programs where local utility might offer incentives or have mechanics in place to find good projects. That's not in the proposed rule, but I think it'd be of value to them. And then I'd say the last point is, FHFA as a regulator or conservator of financial institutions, it's somewhat different than some rulemakings where they're just looking for, an agency might be looking for, lots of people to chime in support of something because the political element is important. I think that's less true here. So, yeah, I'll leave it at that.
Great, thank you. And I just want to let the audience know we're having a little bit of a technical difficulty with getting your questions in. So please bear with us, and we'll try and get those loaded here shortly. Another follow-up question that we had was, one of the concerns some parties have raised that we've spoken to about how to implement this. So while we can make these recommendations to the FHFA, there seems to still be a lot of discord within our own industry about, how to measure.
Martha, I've lost voice contact. Martha, I'm not getting any sound.
Can everyone hear me?
Hi, I think you're back.
Yeah, the system is freezing up on us. I apologize. So I guess I know we've lost some people, but hopefully we still have some time to discuss a couple of questions that have come up. The first one, and I don't know how much you heard of the last question that I posed, was do we feel that the FHFA will take action on incorporating energy use into underwriting if the industry is not necessarily hasn't reached a consensus on which rating systems are appropriate for underwriting or a standardized way for measurement and verification? Do you feel like this could be a potential obstacle, or is it something that they're willing to figure out as we go through this process?
Yeah, I think the latter. This is Bob. Am I off mute?
Yes, you are. I can hear you.
Yeah, I think it's more the latter. I mean, I think they realize, we met with them recently, Philip and I and others, and I think they realize that there are these different systems out there, and I think they would like to, talk to these people. And, I mean, the possibility that they can incorporate more than one, that doesn't have to be all thing, and then see how things evolve over time. So I don't think people should feel constrained that if partial to a home energy score versus a HERS rating versus a BPI rating versus a Earthcraft rating, that they should just go forward and make their case.
Yeah, I think that's generally right. I mean, it's difficult to know, right? I mean, I think we ourselves might learn something through this comment process and see what others have to say. The rulemaking process, I think, is often structured to be a genuine conversation that plays out over time and in writing, and we learn things. But I think, just snapshot, that they are genuinely trying to figure out how to structure products and processes that work. You have to keep in mind FHFA's kind of higher level goal is the safety and soundness of these institutions. So that becomes a very important lens and constraint. So yeah.
Thank you. And I've got a couple of questions here, and I'll just try and go through these. The first is, it seems the simple solution here is to simply include utility costs in the PITI calculation. Has this been broached with the CFPB? I'm not sure what the acronym is.
Yeah. So CFPB is Consumer Financial Protection Bureau, and it is the fairly newly created institution that has a certain level of regulatory oversight of consumer lending products and institutions that make consumer loans. And there has been some discussion with CFPB about the extent to which borrower utility expenses are relevant to the borrower's ability to make loan payments, which is one of the things they're very concerned about. Whether it is a simple matter to include utility expenses when measuring a loan applicant's income, is something that I think will play out in these comments. If that's the view of the commenter and it can be backed up, I think that's an important comment to offer. And I think we'll see comments from other participants who would argue it may not be so simple. But it's a very important point.
The next question is
Bob, do you want to? I didn't mean to monopolize the answer to that question. It's an important question. Bob, do you have?
Yeah, I think you answered it well. And then I would just also add, on a more tactical level, that the Consumer Financial Protection Board, really a lot of their mortgage work has been related to loans that are outside of the purchase programs of Fannie Mae, Freddie Mac, and FHFA. Not to say that there isn't an intersection, but generally, if a loan is eligible for purchase for one of those entities, then some of these other rules don't apply. I think a lot of it was designed to all these subprime loans and teaser loans and things like that of the past or borrowers that just had no business getting into a loan, getting stuffed into some loan. So
right.
I think we need to unduly worry about it as it relates to this reg, but I think as you well stated, Philip, it is a larger issue that continues to play out.
Great. The next question is there a historical example for another measure that the FHFA has approved to push through to the GSE, something that we can learn from?
Well, that is a good question. I think at one level, this duty to serve function is fairly unique. And so there just might not, the fact that there might not be an analog doesn't, we don't learn too much from that. But, offhand, the only thing I can come up with is the kind of scorecard, for lack of a better word, that FHFA uses to gauge the enterprises, Fannie and Freddie's progress on various goals. Bob, does anything come to mind?
Yeah, well, I think something it's a little bit analogous is the Community Reinvestment Act that the commercial banks have to adhere to, where to the extent that they're loaning in what's called underserved census tracts. Generally, those tracts are under 80% median income and below. That they're required to, do some very direct lending in those situations. But yeah, I think, but largely, if this is something unique, it's because these institutions are so unique, sort of public-private bodies where, just the government couldn't mandate everything that they did, so they had goals as opposed to, laws that they had to adhere to. So. There isn't probably a perfect analogy.
And just a couple of questions. The first is, will this kind of public comment period happen regularly with this rule, or is this kind of a one-time thing?
Well, it's certainly not a one-time thing because this is the second time. FHFA offered some duty to serve ideas in a proposed rule, like I don't know, 2010 or something like that. Took comments it has sat since then. It was fairly new. The FHFA was a fairly new entity at that point. And I think in the meantime they've learned a lot and are coming back now with this proposed rule is round 2. One doesn't know. I think it's likely that this will be the sole comment period on the proposed rule, then the final rule will be published, and then you can comment on the final rule. But it's likely this is the sole comment period on the proposed rule.
Yeah, I think getting back to the fact that this is the second, I think it was designed to happen every 5 years. To the extent these agencies still exist 5 years from now in the same format is, yet to be determined. That's a very big debate in Washington. But I think when it was 5 years ago or 6 years ago, whatever the case may be, at that time they weren't interested in energy efficiency and some of the issues they're asking about now, like manufactured housing or rural housing, because the industry had its back to the wall dealing with foreclosures. So I think the bigger concern then was having programs for low and moderate income people to work their way out of difficult loan situations. So this is probably, although it's the second time, it's probably very different than what was in the past.
Great, thank you. And we just have a couple of comments that I'll just read to the audience that some folks have put out there. The first one is, do you think we might be making the answers too specific? Isn't the overarching goal to reduce carbon emissions? What about setting a carbon reduction goal, 10% per loan, 20% for loan products, and ask the market, lender, GSE loan sellers, etc., to devise solutions that work for them and meet their credit risk targets? That was the first comment. Another comment was benchmark EUI, then allow the market to apply value to the variance. So I just wanted to put those 2 ideas out there. And one follow-up comment, similar to how monthly cost is calculated back from principal value by the marketplace using term and interest rate.
Well, certainly in terms of carbon emissions, I mean, I think Philip and I would both say we would love for there to be some kind of carbon emission standard. I don't think this is certainly it's worth mentioning, but I think, this is more about, duty to serve those communities. Now, to the extent that, people are living in communities where they are, and this would be the case in a lot of lower and moderate income communities where people are living in, places where there is higher levels of toxins and carbon in the air. So I think it's worthy to comment on. I don't know if this is, necessarily the right reg. This is more about housing people, but I think it's a good comment. And what was the other aspect of that? Oh, the benchmarking.
Correct. It was setting an EUI target and then allowing the market to apply value to the variances.
Mm-hmm. Yeah, well, I think, certainly, in a multifamily area, that's becoming something that people are looking at. Fannie Mae already has a program. I don't know if they have EUI targets, but they certainly are trying to move their multifamily portfolio to a much greener, portfolio than it's been in the past. And they're actually in cities where there are benchmarking, they're requiring portfolio management scores and things like that to go into the case file. But that's a good point. I think it's pertinent, particularly in a multifamily case.
Great. And one closing question, because we're at 1 o'clock. How optimistic are you all that if we are able to kind of influence their thinking around underwriting standards for these 3 target markets, do you believe that this will kind of ripple through the broader market?
Oh, definitely. I think, at least historically, probably one of the great values of these entities is because they're such a huge part of the market. I mean, they account for something like 80% or more of all the mortgages made in America, even though everybody thinks, oh, I got my loan from First Savings and Loan down the street. They sold it to one of these other entities. But to the extent that they start moving in this direction, then it's like, well, our forms are requiring you to put energy efficiency information on it. So that's something that an appraiser can evaluate. We're collecting this data, so now it's important because you are what you measure. We're putting standards out to our lenders that we're expecting you to do more in this space. So now they're evaluating these lenders. And I think it becomes this tremendous market signal that when they get involved, that the market will turn, maybe not overnight, but certainly in a couple of years.
Great. Well, thank you all so much. I recognize we're at time, and I apologize again for the audio issues, but thanks to those who stuck it out. And we will continue to be sending you information and ideas and kind of quote-unquote talking points for you to use in your letter writing. And again, please feel free to contact us at financethefuture@rmi.org for more information and assistance in this process. And just a special thank you to Phil and Bob. We really appreciate your time and the guidance that you're giving us.
You're welcome. Happy to do it.
Thanks a lot, Martha.
Okay, thank you. You have a great day.
Bye-bye.
Bye.